When we think of US stocks, we usually think of mega cap tech stocks which are rapidly growing their profits and which pay little or no dividend. And yet what we've seen recently is that some of these mega cap tech stocks are opening their cash vaults and starting to pay a dividend. So in this video, we look at the reasons behind that change, what it means to investors, and critically, whether this signals an end to the period of rapid growth. This video is sponsored by Freetrade, a commission-free investment platform which is revolutionizing the world of investing in the UK market. So let's start off with the news announcements, which were pretty surprising. The first one is from Meta when it announced its end of 2023 results. Now, typically they announce that they're going to be buying back some shares. That's not unusual. However, this time around, they announced a dividend of 50 cents per share. Now, it wasn't the only company to announce this. Salesforce also announced its first dividend ever. Now, typically a dividend investor will think about dividend yield. That's the number of dollars of dividend that you get paid for every dollar that you have to pay for those dividends today. Typically, we express that as a percentage, and it means we can compare across different companies. Now, the dividend yield for Facebook, for example, is tiny. It's less than 1%, but still, it's surprising because it's completely new. Now, historically, what we've seen is that the US has been a very poor dividend payer because the deal there has been capital growth. Instead of being paid in income, you're paid because you get capital gain. And as an investor, you're kind of indifferent between those two, usually. So if we compare the current dividend yield on SPY, a tracker of the S&P 500, that's just 1.3%. Whereas if we compare that with a tracker of the FTSE 100, a UK index for large caps, that's much higher, it's 3.8%. Now in the US, if a company has a lot of profit, one of the other things which it typically does is buy back its own shares. For example, if we look at Apple's outstanding shares since 2010, the number of shares has halved. We've gone from a world in which there are over 26 billion Apple shares outstanding to one in which there are under 16 billion. The effect of buying back their own shares is to concentrate your ownership in that stock. Usually it results in a share price increase when that happens. So again, it generates a capital gain. So for US investors, it makes sense to consider the sum of those two things, dividend yield plus something called buyback yield. Buyback yield is the number of shares bought, their total value, divided by the market cap of the company. So some investors add those two numbers, they add up buyback yield and dividend yield to get a total shareholder yield, because both dividends and buybacks benefit you as an investor, although in slightly different ways. Now, it's always great to have a quote from Warren Buffett, and in his 2004 letter to shareholders, he said, "When stock can be bought below a business's value, it is probably the best use of cash." And one of the reasons why he loves his Apple stock holding is that he's been continually concentrated in that holding. He didn't have to buy any more stock, although he did, but the buybacks meant that he owned more of the company. Now, one of the reasons why US investors prefer buybacks to income and dividends is that they're taxed differently, and the tax treatment of buybacks and capital gain is more favorable than the tax treatment of income. Income is usually taxed at federal rates of up to 37%, whereas capital gain is taxed at a lower rate of about 20% or less. So what choices does a company have when it has cash left over at the end of the year? For example, if we look at the income statement from Meta, you can see that it had revenue of just over $40 billion. And if we subtract the costs and taxes that it paid on that revenue, that adds up to a profit of $14 billion. So what can it do with that $14 billion? Well, the first thing it could do is reinvest that money back into its own company. And that way, hopefully, if it invests it wisely, it's going to increase its revenue in future. You'll get organic growth, in other words. However, if it can't think of projects which will generate a profit and where the return on the investment is greater than its cost of capital, then it wouldn't go down that route. It wouldn't do the investments. Alternatively, it could buy companies which could increase its profits in future. Often the competitors will be the companies which it will target. And in order to do that, it'll build up a war chest of cash in order to buy those companies. And of course, the other two options are buybacks and dividends. You give money back to the shareholders or you buy back your own shares. And that rewards the shareholders indirectly by increasing your share price. Today's video is sponsored by Freetrade, a commission-free investment platform which is revolutionizing the world of investing in the UK market. Freetrade offers you over 6,100 US, UK and European stocks, ETFs and investment trusts. And with over 1.5 million users on board and having won the best online trading platform at the British Bank Awards for 5 years in a row, they're a well-trusted trading platform. With Freetrade, investors have the opportunity to invest in a tax-efficient way by opening a stocks and shares ISA. For those looking to consolidate their retirement savings, Freetrade offers a self-invested personal pension or SIPP that allows you to bring all your pensions under one roof. And speaking of ISA and SIPP, Freetrade has a great offer where you can earn a free share worth between £100 and £2,100 when you open and top up or transfer an ISA or SIPP worth at least £10,000 before 5th of April 2024. Curious how it works? Here's what you need to do. Download the Freetrade app, open an ISA or SIPP account with an annual standard or plus subscription on or before April the 5th, 2024. Top up your account or start a transfer for at least £10,000. Keep your account open with a balance of at least £10,000 and they'll drop the free share into your account within 90 days of the campaign completion. Head over to freetrade.io/transfer to learn more and get started. Remember, this offer closes on April the 5th, 2024, and you can find the link in the description as well. So why is it that buybacks have become less attractive for these mega cap tech companies? Well, one reason is that the Inflation Reduction Act in the United States, part of that was to introduce a 1% tax on these share buybacks. And if we look at the fact sheet on that act from the White House, what it says is kind of interesting. Imposing a 1% charge on corporate stock buybacks to encourage businesses to invest instead of enriching CEOs or funneling profits tax-free to shareholders. Now, that 1% tax isn't huge and it probably hasn't put off companies from doing those buybacks, but it certainly had some effect. Another point is that at the moment, US tech companies are quite expensive, their valuations are high, and that means that if you are going to be buying back your own shares, you could be overpaying for them. Warren Buffett's point about buying them when they look cheap is a very important one. If you do overpay for them, it's actually value destructive for the shareholders. How about the other use of cash which we mentioned, acquisitions? Why aren't these mega cap tech stocks using their war chests, their huge sums of cash, and going out and buying their competitors, and that way increasing their profits? Well, here they're probably worried about antitrust laws. When companies get too large, it stifles innovation, and it also creates the opportunity for monopolies. That's not good for the end user because these companies have huge pricing power. So what happens in that kind of situation is the US government or whatever government steps in and breaks up the company into smaller subunits. The company probably doesn't want that. And in the case of Meta, there's already antitrust scrutiny of its acquisitions of WhatsApp and Instagram. Well, how about reinvestment? Well, one of the things that went badly wrong is the Meta project that Facebook came up with and actually led to a rebrand as the company Meta. We probably all want to forget what happened with those really cringy press conferences with Mark Zuckerberg talking to his avatar and the embarrassing fiasco of the avatars with no legs. Investors were really concerned that Meta was simply sinking money into this metaverse project and it wasn't coming up with revenues to match its investment. So I think the worry at the moment is that if the company does reinvest into these almost vanity projects, that it won't generate profits to match the investment. Or as they said in the press conference, they're going to put $30 to $37 billion into ambitious long-term AI research and product development efforts. So what's the attraction of dividends? Why dividends now? So we've seen how the three other uses of their cash have become less attractive. Why is it that dividends are now more attractive? I think the first point is about the type of investor which buys these stocks. If you're investing for growth, then you're quite a fickle investor. The money probably comes in and out of the company and creates a more volatile stock price. By offering a dividend, you've got more retirees who love income investing, and they're probably less flighty. So they're broadening their investor base, and that's probably good for the stock. I think the second point is one about economic uncertainty. In a period of uncertainty, what you really want is not something which can be withdrawn at the drop of a hat in the form of a buyback. What you want is a dividend. It's money that's paid into your brokerage account, and usually it doesn't get cut, because if a dividend is cut, shareholders get really unhappy. Whereas buybacks, they're not so unhappy about them being cut. Also, with dividends, there's no real worry about the company being overvalued. Whether it pays a dividend or not isn't really affected by being overvalued, whereas buybacks really are affected if you buy the shares back at a very high price. And I'd say the elephant in the room is that we're now in a high interest rate environment. Well, high relative to the last decade at least. I'd say that it's just normal. But if you can earn 5% on a treasury bond with almost no credit risk, no interest rate risk if you hold it to maturity, then there's a much higher threshold, I think, for stocks. If they're not paying any dividend at all, no income, then you're probably thinking, well, if I park my money with a treasury, at least I'm going to get some coupons. With my stock, I'm not going to see any value at all, any monetary value, until I sell it. And for some people, that's just not very attractive, particularly when rates are high. Another consequence of higher interest rates is that people are more risk averse. If you can earn a higher rate of interest without taking much risk, well, you probably won't take the risk. The final point, which is made by Aswath Damodaran, is a very good one, which is that this might simply be a sign of a company maturing. If we look at the life cycle of a company, we can think of all the different stages, from startup all the way to decline. Now, when you're a startup, you can't afford to pay dividends because every spare penny is being reinvested back into the company. You're kind of starved of capital in a way. Then you get a period of rapid expansion, and again, all of the cash that you generate will be reinvested back into the business. It's more about getting money into the company from new investors rather than getting money out to investors in the form of dividends. Then as the growth starts to tail off, you get a period of high growth, which is, I think, where we've been with Meta for some time now. And there you can pay a dividend, although Meta, previously Facebook, decided not to. Now I'd say Meta's moving from the period of high growth to something like mature growth, where it's expanding its investor base. It's not going to offer the same kind of growth as it did previously, and if it can't, it has to sugarcoat its stocks with a little bit of dividend. Now, that doesn't mean that growth is going to stop for companies like Meta, it just means it's going to slow down. Now, you might be thinking if these companies, these mega cap tech companies, are slowing down their revenue growth and their profit growth, maybe other companies will just step in to take their place. And I think that might have been true during the period of zero interest rates. Now I think it's much more difficult for that to happen. Firstly, because venture capital money is much less readily available. So if you do want to do a process of blitz scaling, where you rapidly grow your profits and scale up, that's going to be much more difficult without that VC money being thrown at you. Also, when interest rates are higher, if you're going to borrow to grow, that's also a bigger expense. And that'll probably also put a brake on growth. And as I said, now that interest rates are higher, people are more risk averse. So even if you do manage to grow, people won't be so keen to give you their capital when there's something which is less risky, but also gives a pretty good return. So I think this is a trend that's going to continue. I expect a lot of these tech stocks will be giving up their hoards of cash. If I look down a list of the amount of cash which these companies held at the end of 2023, it is pretty staggering. Apple had 160 billion, Alphabet 111 billion, Microsoft 81 billion, Amazon had 74 billion, and Meta had 65 billion. So I don't think this means that growth as an investment style is dead, but I think that there's going to be a shift to value. I've been saying this for some time now, but I really do think that growth is going to be much more difficult in this new macroeconomic environment. Now don't forget our offer from Freetrade, the sponsor of today's video. To learn more about that, go to freetrade.io/transfer, and you'll also find that link in the description below. And, as always, thank you for listening.